Welcome to the Professional Edge. We're talking about asset protection. It's not what you think it is on this session. My name's Todd, tax attorney, CPA, certified financial planner, host here on the Professional Edge for north of 5 years. Think about this for a second. What have you done on your investment portfolio to protect your assets? Well, if we're invested in mutual funds, ETFs, as we call it, stocks, bonds, and mutual funds, then there is no asset protection on you being subject to the market volatility. Now, we've reached record highs, but we all know that that's on paper, and if you've not done anything to protect your investment portfolio, you might want to give our office a call, and I'll give you that number here in a minute. But let's think about this for a second. Your portfolios went up 20% over the course of the past couple of years. That's awesome and great, but if you don't do anything to lock in those gains, then they're just paper gains. Now, what we might want to do is take and peel back one layer of that onion. Take $100,000 or $200,000 out of play, out of the market, not putting it in cash, but putting it into a financial instrument which A, protects your principal 100%. Then, if you are given some credits for interest based on a percentage of an index, let's call it the S&P 500 index. If it goes up 10%, you would participate 80%. If it went up 7%, you would participate 80%. And therefore, in our example, you put $100,000 in, the S&P goes up 10%, you get 80% of that gain. You get an $8,000 credit added to your original $100,000, and therefore now 108 is not subject to market risk. It's protecting your assets. So again, if that makes sense to you, that you want to protect part of your investment portfolio, especially as you get older, a little bit more conservative, we're seeing individuals that are in their 60s and 70s that are 90% invested in the stock market. Crazy to me, but that's what they are. And that doesn't match their risk tolerance, because after we have a conversation here at the Cunningham Center or Atlanta, or even on a Zoom call, we know that their risk tolerance is not that of a wildcatter looking for oil, but their investment portfolio is actually allocated that way. They've not reduced their risk. They're not evaluated their exposure to risk. So how have they protected their assets? They haven't. So that's where we come in and say it might make some financial sense to remove part of this portfolio from market risk, because the preservation of your capital is paramount. Warren Buffett, the one of the all-time greatest investors, has two rules of investing. Number one rule is protect your capital. Rule number two, he says, is don't forget rule number one. So being all invested in the stock market is not protecting your capital. It is subject to market volatility. So again, make an analysis, pull off some of that capital, $200,000, place that in an instrument which is not subject to market risk. That's number one. Number two, you participate a percentage of what the index would provide. That could be the Dow Jones, could be the Euro Index, could be S&P. Everyone's familiar with those. So therefore, you would get 80% of that return on that S&P. So 80% of that, whatever it does, in our example, it says 10%. So you get an 8% credit to your account. Now the value is 108. The market then has a stock market correction, and it drops by 20%. Well, the instant you look at your account in this vehicle, then you would see that your account value is still at that 108. So it doesn't participate when the market goes down. It only participates when the market goes up. So again, for our listeners here on the Professional Edge that are worried about the conservation of their principal, not really the return on their capital, then this instrument might make a lot of financial sense. And to evaluate whether that does make sense, give our office a call at 877-654-9798. That number again, 877-654-9798. So going back to this protection or asset protection, well, it's different than what you're thinking, right? We're not talking about lawsuits and creditor protection and hiding assets and offshore trusts. We're talking about the plain vanilla, doing the right things right, doing the little things right, and they all add up to a big change. So what about protecting your assets in the investment arena? Well, let's look at a mutual fund. You can buy a mutual fund and have no load, or you can be sold a mutual fund with a load from a stockbroker. And that's what they will not disclose to you because they're not a fiduciary. They do not have to disclose to you what commission that front end load is being paid to them. And you can look that up. We have the software to do that, and it can be as high as 5.75%. So you put $100,000 in, that stockbroker who sold you that made $5,750 for selling you that loaded mutual fund. That's egregious in our opinion, and that's why we don't use loaded mutual funds at estate management counselors. We work on a fee basis. We don't want to sell our clients anything, and our clients obviously don't want to be sold anything either. They want to receive professional counsel and advice. So how does this relate to protecting your assets? Well, in today's investment environment, there appears to be no reason in our professional opinion that you should have to pay 5.75% to buy an investment. Think about that for a second. Just to buy that investment, you have to pay 5.75%. On a $100,000 investment, that's $5,750. That's a lot of money. That money is gone forever. It is gone. So if you sell that fund in a year, they're not giving you back that $5,750. That's the load that they charge to allow you to invest in their fund. Well, that fund is structured that way because that is allowing that fund to pay the stockbroker to incentivize that stockbroker to sell you that fund. Well, lo and behold, let's not pay 5.75 years of fees to a stockbroker just for one simple silly transaction. Yes, it is silly because paying that load, that capital goes away, and now you don't have $5,750 to earn a rate of return on. That's protecting your capital, protecting your assets. So if you have a brokerage account statement that have these funds, and then there's an A, a B, and a C after the name of the fund, let's call it Desert Investment A, Desert Investment B fund. Well, those symbols, those A's and B's, reference what type of loaded fund it actually is. So again, if you want an objective review of your portfolio, do give our office a call at 877-654-9798. That number again, 877-654-9798. We'll identify what's in there. It's pretty simple. We have software to do that. It's independent third-party software. So it's not us changing the information to suit our needs. It is what actually has transpired within your account. That's number one. And if you're paying loads, then you're not protecting your assets. You're giving those away. And doesn't make financial sense in this arena, especially when there is no transaction fee brokerage accounts. Charles Schwab's one, Fidelity's one, Vanguard's one. No transaction fee in or out. So wouldn't it make more financial sense if you bought a mutual fund or an investment that all $100,000 that you thought was being committed to that fund actually goes in to buy $100,000 value of that fund? Well, that's what we do at estate management counselors. We want all of our clients' money to go to work for them because when they win, we win. So that's being a fiduciary, because when that stockbroker sold you that A share, I'm sure they didn't disclose that they were going to make $5,750 on the sale of that investment to you. Most don't. They just say, here's the funds, and a lot of our listeners on the Professional Edge don't really understand that concept, which is fine. Let's just not pay that going forward. The water's underneath the bridge on the ones that you have in your portfolio. But going forward, we know you're going to have to readjust, reallocate that portfolio. So let's avoid paying that load. And it could be on the front side, a front end load, or it could be a deferred load, which is a back end load, which means when you sell that investment, you got to pay a load to get out of it. That doesn't make financial sense to us either. Why would you have to pay a load to get out of something? That's on the funds that we use. There is no load to get in, load to get out. So therefore, all the client's money comes off the table. So if the account is worth $100,000, meaning the investments within that account, and we want to move to cash, well, guess what? That $100,000 all moves to cash. It's not subject to a deferred load. The back end load, as they sometimes refer to it, it's all these different names. Oh yeah, there's a deferred load, and a lot of people don't understand that nomenclature, which is fine. So we want all of that $100,000 to come to cash, not to be paid off to the mutual fund company as a deferred load. We want the client to retain their assets. So again, protecting your assets in the investment arena is not paying these loads. So again, look at your mutual fund statement, look at your brokerage account statement. If you have these alphabet soup after the name of the fund, very high probability that you've been paying loads. So if you don't understand it, that's a reason enough to give our office a call at 877-654-9798. That number again, 877-654-9798. Turning to the last thing on protecting your assets within the investment arena, that is on these mutual funds. Within the mutual fund, they have a turnover ratio, which basically says how often these underlying stocks are traded or turned over. Now, we've all been receiving our 1099 for our after-tax brokerage account, and you're having these dividend distributions and capital gains distribution, and you're sort of scratching your head and saying, wow, what's happening? Because I'm paying tax on money I'm not spending. I never got this money, but I'm having to pay tax on this capital gains. So that doesn't make sense. Well, it's based on the turnover ratio within that mutual fund. And again, being a tax attorney and a CPA, advising clients as a registered investment advisor, acting in the client's best interest, we look at this turnover ratio and make sure it's not going to harm the client. So, or is it, where should we place this fund with this large turnover ratio that's going to more than likely have a high probability of creating a taxable event? Well, they're going to issue a 1099 for the amount of capital gains distributions, because when these funds turn over, it's just like you selling stocks and bonds. You have long-term, short-term capital gains just inside the mutual funds, and these distribute these out to the investors that hold these mutual funds. So knowing where to place this and analyzing that turnover ratio so we don't have to pay tax on money we're not spending. It's another way we at estate management counselors help our clients to protect their assets. If you like what you hear here and you want some more information, do give our office a call at 877-654-9798. That number again, 877-654-9798. So again, my name's Todd, tax attorney, CPA, and certified financial planner, host here on the Professional Edge. I appreciate you listening in, and if you go to any podcast platforms, then you are actually able to look up Professional Edge. You'll see these shows, and if you like what we hear and one of your colleagues is discussing what they're going to do or they're planning to do, do give the link out to them. Again, Professional Edge, it's only going to help them make better financial decisions. Again, I appreciate that referral and look forward to you tuning in to the Professional Edge on our upcoming episode.
With today's financial markets, are you getting the personal and professional attention you and your money deserve? Clients of estate management counselors benefit from having one set of professionals advise them on their tax, estate planning, and investment advice. We call that the Professional Edge. Todd is a tax attorney, CPA, and certified financial planner. With over 15 years' experience, he welcomes the opportunity to assist you in preparing for retirement, implement implement effective tax planning strategies and to help you properly plan your estate. His radio show, The Professional Edge, is aired weekly on Sundays at 9 a.m. If you're interested in meeting with Scene, call his office at 877-654-9798. That's 877-654-9798. Do you want to feel more confident about making the right investment, tax, and estate planning decisions? Today, these decisions are more complex than ever. Have you thought about working with a professional advisor and not sure who to turn to? Not sure what qualifies one to be an advisor? Scene Todd is more than qualified as a tax attorney, CPA, and certified financial planner. Scene is with Estate Management Counselors. Estate Management Counselors operates as an independent fee-only investment advisory firm. They're dedicated to gaining a personal understanding of their clients' objectives and implementing professional counsel and advice to achieve those objectives. So take a second to talk with Scene Todd to learn how you can benefit from their multidisciplinary practice where they coordinate their clients' legal, tax, and investment strategies into one comprehensive and integrated plan to enhance and protect their clients' financial security. You can reach Estate Management Counselors and speak with Scene Todd by calling 1-877-654-9798. That's 1-877-654-9798.